stage. So this event is co-organized by ACE and Geoworks. So ACE is a national level startup ecosystem developer that builds and develops the Singapore startup ecosystem. So we are supported by government agencies under the Ministry of Trade and Industry, specifically Enterprise Singapore and JTC. So our patron is Dr. Tan See Leng, the Second Minister of State of Singapore. So for ACE, how we develop and build the Singapore startup ecosystem is by serving 5 key stakeholders in the ecosystem. So they are tech startups, corporates, IHLs, risk capital, who are your angel investors and venture capital firms, as well as a public sector. So for this event, we also have Geoworks with us as well. So I would like to take the opportunity to invite Geoworks to give an introduction of themselves.
Hello. Hello everyone, I'm Simin from Geoworks. So just to share a bit about Geoworks, Geoworks is Singapore's geospatial focused industry center operated by the Singapore Land Authority, which is SLA. Then here at Geoworks, we aim to foster a vibrant geospatial ecosystem in Singapore and beyond. So bring together geospatial businesses such as MNCs, scale-ups, and also government agencies to promote the business growth. We also drive innovation and also build a diverse and well-connected geospatial community. So we are launched in 2018. Geoworks currently houses 26 geospatial scale-ups, which we call them the geotechs, and also have the support of 14 geospatial partners, which we call them the geopartners. Some of the bigger brands such as S3, Grab, Autodesk, or Bentley. Yeah. So next slide. So for more details, if you'd like to, next slide, So for more details, you can go to our official website, www.geoworks.sg. So this is just a brief introduction about Geoworks. So now I'll pass back to Yanling.
Thank you for the introduction of Geoworks. So let's kickstart this session. So we have invited 2 VCs, Vertex Ventures and Golden Gates Ventures, to share their insights in this session. So with us, we have Carmen Yuan, a partner of Vertex Ventures, which is a leading global VC for Singapore, India, and Southeast Asia. So she has served many years in the Singapore's government-backed venture capital initiatives, including EDB Investments and Spring Seeds Capital, where she worked closely with many startup companies in Singapore. So also with us, we have Michael, who is a partner of Golden Gates Venture. So he joined the firm in 2013 and is currently leading growth venture efforts, which includes LP fundraising and portfolio management for Golden Gates Ventures investments at Series B and beyond. So he has over 20 years of experience in helping innovative businesses obtain resources, insights, and expertise that they need to be successful. So before we start the session, if anyone has any questions for Carmen and Michael during the session, we would like to invite you to send your questions via the chat box in Zoom. So after the sharing, we will be doing Q&A to address some of these questions that you may have. So let's kickstart the session. So some of the things that, startups as well as the stakeholders in the community that we would like to find out from 2 of you is that what are some of the key industries and technologies that VCs are looking out for in 2021? So either Carmen or Michael, you can take the conversation forward.
Okay, I can go first. Thank you, Michael, for letting ladies go first. Hi everyone. Thank you so much for making time to join us this afternoon. It's quite exciting to see that there's 86 of us present on this afternoon. To start with, what are some of the key industries and technologies VCs will look for in this year? It has to map back to what the VC's purpose of existence is for. So for us, it will kind of like map back to the areas of focus that we will invest in. And so for Vertex, we have 4 areas that we look at. So one is in the enterprise space. The other one is actually in consumer internet. The third is in fintech. And most recently, we added on health tech services and healthcare services. So if you were to ask me, for 2021, what will be some of the areas that we as as VCs look for. So the usual suspects will continue to be digital commerce, fintech, edutech, health tech. Right? We have seen this thesis play out in 2020, given the social distancing and the whole issue about working from home. And so I just read a report on food delivery and how food ordering and online content consumption has actually increased by about 31% year to date, December 2020. And when COVID just happened, food delivery companies were busily laying off riders. But soon, before you know it, they all came back and they were all riding even harder because of the step up demand for people who just started ordering from Shopee, Lazada, and I've even heard grandmas started ordering their first online ordering experiences. So this trend will continue. And I look at it as digital ordering, not just constrained or confined to food, but also entertainment and commerce. What this means is that when the ordering continues on, the supporting industries will stand to benefit. So in this case, the supporting industries will be things like your logistics, your packaging and design, your digital marketing and payment, just to name a few. Right? And with commerce keeping the engine of the economy going, we can expect that the commerce thesis will continue to grow. So this commerce thesis will not just be e-commerce general, but it will probably be more vertical kind of e-commerce, such as direct to consumer, your social commerce, group buying, live stream, and the likes. And with it, I mentioned about payment. So then it means that we can also look at perhaps payment itself will get very exciting and interesting. You have got the buy now, pay later model, you've got loan models, etc. So it looks to be exciting. Yep.
Yeah, and just to build on top of that, I guess we're of course operating in the same region. We see a lot of similarities, but maybe a few things to add on. I think last year during COVID, a lot of our investors, but also partners and people looking outside the region, kind of looking in, we're asking, what are the biggest changes, or are you changing your thesis, or are you changing the industries you're looking at since there's COVID? And yeah, food delivery has changed, e-commerce has changed, it has heavily picked up. What I've noticed across the board is that hasn't been a big shift in our investment thesis or investment strategy. So we kept on investing and looking for for kind of similar verticals. To Carmen's point, yeah, social commerce has been picking up significantly. What I found interesting though, just to give a little bit of a different spin, is because people were confined to their homes, companies, employees were confined to their homes, we're seeing more and more innovation happening as well. And I want to give two examples. So from Singapore, there are a number of companies that are now focusing on quantum computing and how to apply quantum computing, for instance, for communication. Now that's more on the enterprise side, something, for instance, we haven't invested in historically. But because of there is such rapid growth in tech talent, such rapid growth in access to technology, we're seeing smarter and smarter solutions coming from Singapore as well. Another example I'd like to mention here is healthcare. Of course, healthcare is a very, very big space, but we're now seeing within healthcare a few niches. So one example is startups that are doing stuff around fertility. So there's a number of companies in Singapore that are trying to address that issue as well. So where I'm getting a lot of excitement is, I guess, more focus on sort of deep tech enterprise solutions and some niches within the healthcare space that could become very, very big industries moving forward.
Yeah. Yeah, it's interesting. And actually, it'll be interesting to hear from our audience. What do they think is interesting and exciting for them in 2021? So please feel free to type into the chat. And I guess we will depend on ACE and SLA or Geoworks to help us collate the findings.
Yep. So yeah, from the audience, if you have want to chime in or any key insights that you may have, feel free to on your video and also unmute yourself, so that you can share with our VCs what are some of the insights that you may have. But yep.
Yeah, or if not, it's just to type into the chat group, right, so that we keep this conversation flowing. But yeah.
Yep. So yeah, thanks for sharing your insights. So yeah, it's very insightful, especially some of the trends that because of COVID, it has accelerated it, especially in the food delivery space, buy now pay later, and some of the sectors that are enjoying the tailwind because of COVID. Yeah. So Also, what we have seen recently is that, despite COVID-19, right, there's actually a strong interest in, companies looking to IPO. And also, as we all know, SPACs is also gaining popularity for tech startups looking to list on the public stock exchange. So just like to get, understanding from, both of you, how about the VC's investment climate now? Are we seeing an increase in VC investment funding among tech startups? Or are there higher valuations level that are actually raised during the fundraising rounds?
Yeah,
Mm.
yeah, yeah, yeah.
Yeah.
Okay, I can go first
Yep.
again. Yep, thank
Yeah,
you.
happy to kick off as well.
Okay, no, go ahead, Michael. Go ahead.
Yeah, sure. So I just want to maybe kind of take a little bit of a different angle. I think if you look at the position of capital globally, we all know that capital has been, I would say, not expensive over the last few years. Interest is extremely low. So what is happening is that you have, whether it's family offices, big corporations, institutions that are effectively flushed with cash. Of course, a big portion of this cash will go into public markets, real estate, kind of larger growth equity assets. But more and more of that capital is looking for yield, and they're able to do more risky investments. So they're looking for a bigger exposure in the venture asset class. And we've seen it across the board. We've seen it in Europe, we've seen it in the US, we've seen it in China, and we've seen it in Southeast Asia as well. So to me, the rise of SPACs, the number of successful IPOs in the US, investors being able to kind of liquidate their positions, it stemmed a lot from investors been looking for larger institutional investors, been looking for yield, and technology has shown to be extremely robust since over the last few years. And hence, I think there's a report that was maybe it was this morning, I saw it on Deal Street Asia, where I think the private equity asset class has raised more capital than ever before. And it kind of continues to grow. And we're seeing something similar in the US as well. So I think the trend of funds raising more capital, private companies raising more capill, and whether at a high valuation or not, is driven by a lot of dry powder being available in the market.
Yep, absolutely. I agree with what Michael has noted, and it's true. Interest rates has been very low. From the ground level, what we have noticed is that companies valuation kind of like double speed time. I'm sure Michael can also attest to seeing companies like that, where just from 2 weeks ago, their valuation could have doubled. But actually, when you look at it, what has changed in the business fundamentally? 2 weeks, nothing, other than the fact that they were just being given quite a lot more term sheets. And they felt that, our plan was actually to come out and fundraise in Q3, but since people are coming to us right now, and not just one, but many, so let's just take the money now, and the valuation just gets escalated. So to me, it's one of like, when will the music stop, right? And certainly you don't want to be the one holding the shorter end of the stick when the music finally ends. So at the end of the day, what is necessary is for founders and business owners to still relook at the company fundamentals, not to be worried that you won't have investors. It's a lot of hard work, but if you are showing clear signs of like your growth trajectory, if you are showing yourself to be trending towards cash flow positive, there will be investors. It's just maybe we are not the right one, but there will be investors. Then when it comes to SPACs, the SPACs fever will continue on. And it is interesting to just follow some of the cases of where some of the SPACs companies will go. SPACs is a useful vehicle for investors to get some exits, for companies to raise funds. But at the end of the day, if the business fundamental itself is not right, is weak, then SPACs can turn around and become a double-edged sword to the company. And simply because the SPACs investors actually have the right to redeem. And when they redeem, they also short the shares. And that can become double whammy for companies. So just be mindful. The fever is going hot and strong, but just be mindful.
Yeah, I think the one of the most important things to note is it doesn't really matter if you decide to do a regular IPO, list to a SPAC, do a direct listing. The fundamentals of business, like running a proper business, having sight on being cash flow positive, having a strong management team, continue to grow. Is it doesn't matter if it's a SPAC or a direct IPO. It's still the same. And I think that founders and companies shouldn't forget that. Of course, a SPAC is more flexible. You can list faster, but the basic fundamentals are still in place.
That's very insightful. So definitely it all boils down to the business fundamentals at the end of the day. Doesn't matter whether your startup is able to fetch a higher valuations when investors are looking to invest in the company. All they're looking at is a business fundamental. So talking about business fundamentals, so as VCs, what are some of the key consideration factors that you look out for when assessing the scalability of startups?
Okay, I can take a crack at this. So there are many considerations of why we invest in companies. So one of our theses is when we invest in companies, we want to make sure that they have the potential to become the regional champion, if not the global champion, right? So which means that we have got very high bar for companies that we want to partner with. And that is natural because we are going to be pouring in our time, our lives, our resources, not just me alone, but my team, my entire team behind the companies that we back, right? So as a result, we will need founders to be very ambitious in terms of their business thesis, what they want to achieve out of it. The journey is going to be very, very long, and therefore they have to have the determination to continue that journey. Right. So one of the things is the ambition of the thesis, whether the founder has a game plan on how he may want to achieve this thesis, how he wants to execute onto this thesis, and whether the founder himself is healthy enough, because this is going to, like I mentioned earlier on, is an arduous journey. So he's likely to have to put in 7 years, 10 years, 15 years to execute on the business. And there will be many, many stressful moments when he will be running low on cash, when he will have wrong hires, when he may have horrible partnerships that he will need to unwind, right? So he will have to have the mental capacity and the physical capacity to carry on. And of course, from wanting the companies to be business champions or regional champions, then the question is really competition. Is the thesis one of replacement, or is it one of generating a new business segment, identifying a new business segment? If it is about replacement, why is it that this company will have the advantage of becoming better than the incumbent, right? And if it is about creating a new business segment, how are they going to sell this new concept to, let's say, the enterprises? Are they going to subsidize the adoption, etc., right? And then the team members, are they team members who are willing to sacrifice alongside the founder, or are they the kind that is quite happy to look at this as a lifestyle change, right? So, and finally, the other way of growing is actually by acquisition or inorganic. So if they are looking at growing by acquisition, nothing wrong with that. Then the question is, have they considered the possibility of an indigestion, and whether or not they are at the right stage of their life cycle to even acquire a company? If their foundation is weak, are they ready to acquire companies, or are they better off just fixing the internal problems and growing organically first?
Yeah, and if I can add to that a little bit, whenever we make an investment, and it's specifically if it's a company at Series A or at the Series B stage, you want to make sure that they utilize the capital specifically for growth. The most difficult thing is fundraising as a company is very hard. Some companies are able to do it fast. For some companies, it takes a longer time. Typically, fundraising is seen as a moment of celebration. Of course, it's a big milestone for the company itself. The difficulty is, though, that the moment you get the capital in the bank, that's actually where it starts. Because the expectation is that your company, in terms of growth, will grow a 2x over the next 12 months, or even more. And that puts pressure on your organization, on you as a manager or as a founder, or your co-founders, on your team, your employees, and even your private life. So what we're trying to do is really gauge whether the founding team has the ability to really make sure that the company grows when there's a new investment. The worst thing that can happen is if you look at venture money, it is it is effectively expensive, right? Because it's not interest based, it is equity based. So you're giving up a part of your company for the cash you receive in return, and hopefully some added value as well. Um, you need to make sure that you spend that money as effectively as possible. So instead of sort of saying, "Hey, it's a milestone, we have money in the bank, and we can take a step back," no, you need to take 10 steps forward, because it's extremely important that the company scales from here on end. And that's where sort of, if you, from a founder's perspective, if you look at how should I define my growth, yeah, look at the markets that you're in. Can you expand to other markets? That's something we find very important. How much depth is there in your product? How much depth is there in your revenue? Have you exhausted one sort or one type of revenue, and you need to find different revenue streams? Where are you in your market? Are you the number 5 in your market in terms of market share, or are you the number 1? If you are the number 1, how much more can you grow moving forward, or kind of have you plateaued? All things that you kind of need to take into consideration the moment kind of, we as an investor look at growth in a company.
Thanks for sharing. So I think one of the key things, when VCs are looking for when they assess startups is also, the management. So the management's ability to, allocate capital efficiently and effectively. And, this is especially important when it comes to, early stage and growth stage startups, when startup founder are trying to execute on an idea to make it a reality. So just like to, ask both of you, what are some of the management traits that, you as VCs look out for when you invest in the startup's founder themselves?
Yeah, I'd say for management sort of characteristics, I'm a little bit older. I'm 45, so I might be a bit more traditional, I guess. What I find important is when speaking with founders that they're focused, and they're heavily focused on executing in their business. I think that the biggest trait strong founders have is they understand urgency. If there's anything wrong within the business, they immediately act, drop everything, and then make sure it's resolved. The worst thing that can happen to a company is there's a small issue, it becomes a bigger issue, and the founder doesn't act on it. And those smaller issues that become bigger issues can be detrimental to the company. So for me, I always look for the ability for founders to really execute. And I guess the second thing is, because the relationship between a VC and the founder, and many people have said it, it's like a marriage. It's a long 7, 8, 9 year, sometimes 10-year relationship, which means to Carmen's earlier point, you'll go through the ups and downs. It's not always going to be an amazing ride up. There's going to be rides down as well. So for us, it's important to get a sense whether we are able to work with this founder over such a long period. So there's needs to be a lot of trust. So as part of sort of our initial conversations, we spend a lot of time with the founders and trying to get an understanding of who they are, type of person, background, how do they lead teams, do they have a big ego, are they humble, are they strong leaders, do they like working in teams, etc. So we just get an understanding how they operate, and that helps us assess whether we should invest, yes or no.
Mm-hmm. Yep. I've recently written a post on the ups and downs of being a life of a founder, right? And this is based on an observation of many founders, but when I was writing that, it was with one specific founder in mind. And recently, somebody was asking this founder, what was it that got you through all these years? And the response was, even the team members, the employees of that company, said that the founder had grit. So to the point of what Michael had said, it is focus, right? Determination, perseverance. You just have that vision and you execute on it in good times and less good times, right? But that journey cannot be a one-man show. So that team has to come around you. And especially when we are saying regional champion, that means to say you must have presence in a few regions. You can't be there simultaneously, right? So even if we can beam people over, the technology is not quite ready yet, right? So you need to work with team members. And then along the way, you will have wrong hires. How do you acknowledge the mistake that you have made? Acknowledge it quickly, If you have to fail quickly, fail fast, and hire carefully, and make sure that the next time when you do the run, you have got the right people on your team. That is quite important. Now, there was a question asked by Timothy about whether or not VCs have preference to invest in serial founders. I think look, the person that I wrote about, this is his first venture, right? And they have executed well. I think at the end of the day, serial or not, end of the day is the traits of the individual, the integrity, the courage to go where no man has ventured before, and the ability to just stay true to his cause. And when in doubt, consult. We are there as investors, and you have to exploit your investors for some good reasons, right? They have a big chunk of your company, so you should exploit us. We have got a little bit more experience, given that we have seen more cases and more problems as a result. Yeah.
Yep, thanks for sharing. So yeah, that's definitely very insightful. So one last question, to both of you. So what are some of the most common mistakes by startups in the early stages of their business? So just some piece of advice to some of the startups here that are actually trying very hard to scale their startups from early stage.
Yeah, it's oh man, it's always difficult to kind of talk about mistakes. To me, it's still, I've made 100 mistakes in my life. For me, it's always kind of about the learning journey. If you're a first time founder, there's a reason for calling it a first time founder. You'll run into situations that you've never encountered before. So you act, upon what your best judgment is at that point in time. But a few things that I've seen earlier, where I think, okay, you could have done this differently as a founder. I think the biggest thing is giving away too much of your business early on. It is typically detrimental to later stage rounds. And the reason is, as an investor, you want to make sure that the founding team is vested in this company over a longer period of time. And if you own 2% of your own company and the rest is owned by others, it's going to be difficult to stay motivated. You might ask yourself, am I working for someone else, or am I doing this for myself? So that's to me, that's very important. I like it when founders sort of jump into an industry which is entirely new to them. I do feel that if you are at some point in time looking to get an investment, you need to understand what you're doing. And you'll see a number of number of founders that come from an entirely different market, and that, for instance, go into the health tech industry and are trying to sell products to hospitals. That is a specific skill set where I think you either need to find someone in your team that has that experience, or build that experience yourself. It becomes very difficult when you take on capital and your company needs to grow, and you don't have the network, you don't have the expertise, kind of don't know where to start. Then it becomes very, very difficult. So just get a good understanding of the industry that you are focusing on. And then the thirdly, I would say, try to find the right partners. And whether it's investors, whether it's commercial partners, I feel that I'd rather see founders having longer conversations to build trust, and to build confidence and conviction to work with someone, than make a decision that's too fast, too rash. You'll end up signing a contract that you're stuck with for the next 10 years. So those would be kind of my three pointers.
Yeah. So starting from the same point of founder giving away too much, but in this case, what I've noticed is sometimes, because founders may not be tech people to start with, so they feel that they need to rely on people with the engineering know-how, the technical knowledge. And so when they have not really raised a lot of capital, what they did was to give away a little bit too much of the employee stock options, right? Too early, too much. And subsequently, when they realize that, oh, this guy actually cannot quite deliver, it's very hard to claw back. And even if you can claw back some, you will have a passive shareholder whom you will feel some emotional imbalance because you have already given away too much. So my advice to founders is, yes, you will not be all and know all. So you should learn how to pace out your employee stock options, your ESOP. Don't be too generous at the start. And number two, why then the second part is actually giving away too much of the company. And I also echo Michael's point. We have seen some companies where it's really quite sayang, you know, when I look at it, I'm like, my goodness, the business seemed to be quite okay, but the founder is actually working for the shareholders. And this is so wrong, especially when they're in a Series A stage. Then what does it mean when you come to Series C? They will really be an employee, right? That doesn't help. So one other way is actually for founders to have a very close eye on their cash flow. The reason why they raise too much is because probably they are less familiar with the way the bloodline of the company will go. When will they collect cash? Maybe they actually do not, maybe they have a lot of outstanding ARs, right? They are just not sensitive enough. And so that's why they are bad in managing cash flow. And so they are continuing to chase after revenue numbers without looking at the cash flow. And then they realize they run out of money. And so they raise funds. And when they cannot quite prove the business model, the valuation gets a biting, right? Gets a beating. So sometimes I feel what is more important right after the engineering know-how is actually the financial know-how. You do need to have somebody who is not just helping you to do your claims, but helping you to have the sensitivity to your financials. And then the third thing is actually in terms of your markets. You got to have clarity on which market you're going after. Are you going after the enterprise market? Are you going after a certain domain within the consumer market? Be kind of clear rather than to try to do multiple markets at one time, because it will land nowhere.
Yep. Thanks for sharing. So just now during the session, we talked about the business fundamentals of startups. So we have one question from one of the audience. So do VCs also look at the intellectual property of the startups that they are going to invest other than looking at the business fundamentals? So could you share based on some of your experiences?
Yeah, I would say that there are cases where IP becomes extremely important, and reason being it could be a competitive advantage for the company itself. That's where we want to make sure that the sort of IP is properly protected, and sort of all measures have been taken. I do have to say that if you look at a lot of the consumer-facing companies, they typically don't have any specific IP because it's all based on kind of general technology which is widely available. But we have a few companies also in our portfolio that do kind of build IP. One company here in Singapore and one in Korea, and that's where, as part of the due diligence, we also do due diligence on the IP. And the biggest point for us is how defensible is it?
Yeah. So, we invested into a platform that helps companies with their intellectual property, right? So there's a company that started out from NUS Enterprise, PetSnap. Their clients will basically be the R&D departments, the intellectual property offices of corporations. So to the extent, yes, we believe in companies having to protect their intellectual properties when it's applicable. And in fact, Dyson is big because it has got great IP behind the products that they created. So linking this a little bit further, like what Michael said, not all companies need to protect their IP. Not all companies' business models is dependent on IP. Right? Some of them is just really executing a bit faster than others. But if you are looking at becoming a product company with something that is unique in how you maybe run certain algorithms and provide certain results quicker, then you should look at having an IP angle to protecting what is giving you that added advantage. Yeah.
So thanks for sharing. So we also have received another interesting question. So the question is, how can founders know which VCs are more willing to go into a deal together and co-invest in their companies? Are there unsaid alliances among the VCs in Southeast Asia?
Let me take a crack at this again, Michael. So my take on this is, as founders, you shouldn't be so worried about the alliances or which are the ones who will likely come into your venture, because at the end of the day, sometimes the people you would like to be on your share cap table, they don't end up being on your share cap table because they are on your competitor's share cap table, right? So they will never be on yours. So as a founder, your duty to yourself and your other shareholders is really to just speak with as many investors as possible, because you do not know what I may be thinking about, what Michael could be thinking about, and there could be a synergy. Although we didn't say that, oh, we are looking at companies in this space, but there could be a synergy and it could make us interested, right? So yeah, it shouldn't be too worried.
Yeah, and maybe just to add a few things, I definitely agree with Carmen. Just make sure that the VCs you look out for are a fit for you, and not a fit for each other. Luckily, there's a lot of community sense in the VC industry. So luckily, we tend to cooperate and share deals. That happens quite often. But yeah, you need an optimal mix for your company that works best. And the VC that you trust, that you think you can work it over the next few years, that is more important than having sort of a group of friends on sitting on your cap table. So I wouldn't worry too much about it.
Yes, thanks for sharing. So yeah, very interesting question that we have here. So next question. Okay, how, I think this asked by one of the startup founders, how do VCs determine the valuation of an early stage startup? And I think for this question, especially so for early stage startups that are pre-revenue.
Yeah, it's always an ask, and I guess for each VC, they will approach it differently. And of course, you're dependent on the team as well. I've seen second or third time founders having a easier fundraise pre-revenue because they've shown historically that they can build a company and they can successfully exit as well. So that makes a difference even in valuation. What we tend to see at the moment is when the companies are really pre-revenue and also kind of pre-traction, that the preference is to do it through a convertible note, and whether it's a SAFE or any other form. It just takes away the difficulty around putting a number on the valuation. And then when the company reaches some form of revenue or some form of traction, it's then easier to have a discussion around valuation because at least you can benchmark a little bit. But anything pre-revenue tends to be based on a convertible note.
Yeah. So for us, we invested into a company called PACE, PACE. So this is founded by a third time or fourth time entrepreneur. So to his benefit, and he has been able to sell his earlier ventures, and hence when we invested in him again, it was pre-revenue. It was very much ideas that he had. He started some traction by talking to people, but certainly pre-revenue, and we were able to converge on a valuation. But this is not usual for us, especially since we are a Series A kind of an investor. And we do this kind of pre-revenue extremely selectively. For companies that are starting out, actually, you should consider speaking with angels. I know we have got quite a number of angel investors. Some of them are actually amongst us, right? While they run startups, they are also angels in their own capacity. So you may want to speak with the angels first, and that you can get it off the ground before you speak with VCs.
Yeah, definitely. And also what I tend to do is when we speak to companies, even if we don't invest, when we speak to companies at early stage, and they're trying to get a sense of what number should I put in my company. I'm from the sense of if you are a little bit more conservative on the conservative side, because please know that you are going to raise a next round. The moment you start off with an extremely high valuation at pre-revenue, you have to prove a lot within the time between now and your next round, because you want to have a higher valuation. You don't want to have a flat round. So you might want to be, if you really want to put a number to it, you might want to be a little bit more conservative. It's easier, to go from a lower step to a much higher step than go from a very high step to an even higher step. So just be a bit cautious there.
Thanks for your question, your answer. So let's take one last question from the audience. So I'm pretty sure that for both of you, you have received multiple requests from startups asking to, look at their pitch deck, to have a meeting, have coffee with them, to explore, investment opportunity. So in your point of view, as a startup founder, what is the best way to approach a VC such that the VCs will be interested to have further discussion with the startup?
I think first is don't spam all the VCs all together at one time. So there are a few instances, thankfully it's only a few, where they basically send a tool and everybody's email is on it and they say, dear investor, I'm trying to fundraise. Could I have some of your time? And we're like, okay, interesting, but wrong strategy, right? It gives a certain impression that you're basically carpet bombing everybody, right? So in such instances, the chances of the business request going into the trash box or spam folder is actually quite high, right? I think both of us, plus all the other VCs, we have got social media handles. They can reach out to us over there, and we do have team members. So if not through us, it could be through our team members, and reaching out to us and maybe having a very quick initial chat over Zoom. I think those actually helps. So if something good comes out of COVID, it was actually the efficiency of conducting meetings over Zoom in quick succession.
Yeah, fully agree. And I'll just add one small thing when it comes to sending an email to every single VC. The one thing is, we are colleagues in the business. We do speak to each other. So if you send the same email to every single VC, even if it's BCC'd, we tend to know. So I would advise do a little bit of homework, the same way we do homework on the companies that we tend to invest in before you reach out. And whether it's Vertex or Golden Gate or any of the other VC firms, just do a little bit of research of in which companies have they invested before, and have they invested in a similar company as mine? What is their typical check size? And I know you can't find the exact check size, but you'll know that if it's a Series A fund or a seed fund or even later stage. So get a sense of what their preference is in terms of the stage of their investments. And then look at their team. Typically for all the VCs, you can find their team members online. You can find them on the website. Reach out on LinkedIn. If you can't reach the partner directly because they might be busy in a deal or fundraising or doing an exit, try the principals, try the associates, try the Twitter handles. But it's important to do a little bit of homework so you know why you are looking specifically for this VC. And even maybe add it in the description, like I'm reaching out to you, Vertex, or I'm reaching out to you, Golden Gate Ventures, because of X, Y, and Z, or you have in a portfolio, which could be a strategic partnership for me. Give a bit of more reason why this VC should be looking at your pitch. Just do a little bit of homework there.
Very interesting. Yeah, thanks for sharing. So I know that just now I said it's the last question, but we have received one last question, which is rather interesting. So this audience asked, what do you think of the deep tech in this part of the world, Southeast Asia? Is Southeast Asia ready for deep tech startups and investments into them?
Yes. That's my answer. Yes, because I think between Carmen and myself and some other VCs as well, we already making investments in deep tech that are coming from this region. So my answer is yes. I would have to say one thing. It means it's different when a company is competing out of Singapore on a global scale, on a regional scale, or on a local scale. So when we tend to look at companies within the deep tech space, and they tend to be more global than other companies, we do look at the competitive landscape a little bit deeper because we then need to understand, is there any technology advantage that this company has? Is there any specific application that this technology has in the real world that we can bank on? Is there something unique about the founding team? So it takes a little bit of a different and deeper due diligence for us to understand whether we can invest in it, yes or no.
Yeah, we don't have enough, but we have had companies that were exited, right? So for example, you might remember a company called Newtonomy. They were in the autonomous vehicle space. They got acquired for $450 million by Delphi a couple of years ago. Is this deep tech? You would think that it is deep tech, right? But you may also say that, oh, it's unfair advantage because they have got some collaboration with MIT, etc. Well, true. But we also have got other guys who also have got certain deep tech companies. So you can see quite a number of them from Entrepreneur First or even SG Innovate. They are deep tech. What I would say is that actually the ecosystem around Southeast Asia is not deep enough to make deep tech companies successful for Southeast Asia, sadly. We might need some time on that. Hence, as a result, our deep tech companies often have to find investors from the US so that they can have a stronger hop-off point to get into the clients on that side of the world. But yes, we do have deep tech companies.
Yes, thanks for answering these questions. So we have come to the end of the Q&A, and I would like to thank Carmen and Michael for spending their time to share the insights to our startup community. So before we end up this session, there are certain announcements I would like to make. So this is our first part of our Tarik session, and we have another second session happening on 28 April, same time from 3 p.m. to 4 p.m. So startups may sign up for a chance to participate in a short live pitch, as well as hear from a founder directly on his fundraising experience. And also upcoming, we have various corporate innovation challenges that startups might be interested to actually sign up for. So we have two corporates, Panasonic and Nishimbo, who are looking for certain technology that they would like to work together with the startups to co-develop. So if you're interested, feel free to drop a note to ACE to register for the session. And with that, once again, I would like to thank Carmen and Michael for your time for this session. It has been a very, very insightful session here, and I'm sure the startup founders learned a lot from both of you. Yeah, thank you.
Thanks for having us.
Thank you. Thanks.
Thank you. Thank you.
Bye.
Bye-bye.